Imagine stepping into the world of real estate investing, maybe even owning property that pays you every month, without the daunting hurdle of needing a massive down payment or spending years painstakingly saving up cash. Sound like a far-off dream, something only for those already wealthy.
It really does, doesn't it? It's the classic picture. Real estate investing immediately makes you think of, well, huge bank accounts, right? And needing hundreds of thousands ready for down payments, closing costs, maybe big renovation budgets. It just feels incredibly out of reach for, the average person.
Absolutely. That wall of upfront cash, that's the mountain that seems impossible to climb for so many people who want to get started. But what if you could actually just find a path around that mountain?
And that's exactly what we're trying to do in this deep dive. We're pulling back the curtain on strategies, methods designed specifically to let you invest in real estate with, well, significantly less money than you'd normally need. Sometimes you might even start with very little or perhaps effectively no money down, depending a bit on how you define no money. We've really gone deep into a lot of sources for this one.
We really have dug through the material. We're talking expert articles laying out the nuts and bolts, detailed guides focused specifically on creative financing techniques, and really importantly, some incredibly insightful real-world discussions, anecdotes shared online, like those sometimes quite lively, even alarming conversations we found on forums like Reddit. They give you a real ground-level view of what actually happens.
Yes, exactly. We've tried to distill insights from all these different viewpoints to give you a comprehensive, kind of grounded look. So, our goal today: to unpack the most compelling, the most practical, and some genuinely surprising ways people are navigating the real estate market without those deep pockets. We'll highlight how these methods actually work, what's truly important for success, and maybe most critically, shine a really bright light on the potential traps and what you absolutely must watch out for.
Okay, let's roll up our sleeves then. Let's unpack this.
Right. So, let's start by setting the stage, acknowledging that huge challenge you mentioned: the big chunk of upfront cash needed for traditional real estate investing. When you talk about buying rental properties the usual way, lenders typically see them as, well, higher risk than the home you live in.
Why is that? Seems straightforward enough.
Well, statistically, people are just far less likely to default on the mortgage for the roof over their head compared to an investment property. If the market turns south or, tenants disappear, walking away from an investment is, financially speaking, an easier decision than losing your home.
Right. Yeah, your own shelter is always priority number one. An investment property, even if it's important financially, it's a different calculation if things get tough.
Precisely. And because lenders perceive that higher risk, they demand a bigger financial cushion from you, the investor. So that usually means a down payment of 20%, sometimes even 25% or more. Plus, you've got closing costs, easily another 2% to 5% of the purchase price. And then you need cash for initial repairs, maybe renovations, and definitely some reserves stashed away for vacancies or unexpected maintenance. It adds up incredibly fast.
So that initial barrier isn't just the down payment itself. It's kind of this whole constellation of costs surrounding it. It can feel totally insurmountable if you're not starting with a pretty hefty savings account already.
It really can. But the core idea, the thread we've seen woven through all our sources, from the structured guides to the messy real-world stories, is that you don't always have to tackle this problem head-on with just your own saved cash. Things like creative financing and using smart, sometimes, let's say, unconventional strategies can offer alternative ways in. It's generally less about finding illegal loopholes and much more about intelligently leveraging different resources you might have access to.
So, thinking beyond just the standard bank loan and your personal savings account, what kind of other resources are we talking about here?
Well, it could be leveraging your own living situation, right?
Yeah.
Your need for housing actually becomes part of the investment strategy itself. Or it could involve using other people's money through partnerships, online platforms, or specific types of loans designed for this. Or quite often, actually, it's about applying sheer hustle, deep market knowledge, and maybe some creating deal structuring to find opportunities and make them work with minimal cash out of your own pocket.
So the goal isn't always having the cash yourself, but finding ways to access it. Or maybe structure the deals differently, or substitute your own effort and knowledge for that capital.
Exactly. It's about recognizing that capital isn't just cash in the bank. It can also be leverage, relationships, information, or, good old-fashioned sweat equity.
All right, let's dive into our first big category then. This feels like maybe one of the most accessible starting points for a lot of people. Strategies that leverage your own living situation. This is about investing where you already are, or maybe cleverly planning where you're going to live next.
Yeah, this approach is incredibly popular, especially for, say, first-time buyers or folks just dipping their toes into the investment world, mainly because it often lets you tap into more favorable financing options, the ones designed for homeowners, not just investors.
And the absolute cornerstone strategy here, the one everyone talks about, strategy number one, house hacking.
Yes, house hacking. The basic concept is pretty straightforward. You buy a property that has more than one potential living space. So think a multi-unit building like a duplex, triplex, or even a fourplex. Or it could even be a larger single-family home with spare bedrooms, or maybe a basement suite you can rent out. The key thing is you live in one of those units or rooms yourself.
Okay, so you're not just a landlord in this scenario. You're an owner-occupant and a landlord basically under the same roof, or at least on the same piece of land.
Precisely. And this is where the little or no money down aspect really comes into play powerfully. Because you are designating this property as your primary residence, you become eligible for owner-occupied mortgage products. Probably the most well-known is the FHA loan, which is backed by the government, and it allows down payments as low as just 3.5% of the purchase price.
3.5%, that's huge.
It is. And if you happen to be an eligible veteran, you might qualify for a VA loan, which remarkably often allows for a 0% down payment.
Wow. Okay, 3.5% or even 0% down compared to the 20% or 25% we just talked about for a pure investment property. That is a massive, massive difference in the cash you need up front.
It's a truly game-changing difference for a lot of people. And critically, these owner-occupied loans typically come with lower interest rates compared to loans for investment properties. Again, because, as we discussed, the lender sees less risk when you're living there.
So you get into the property with significantly less money out of pocket and at a lower borrowing cost.
Okay.
Then you fill up those other units or rooms with tenants. What's the financial goal once they're in?
Right. So the financial magic potentially happens when the rental income you collect from the units you aren't living in is enough to cover your entire mortgage payment. That's principal, interest, property taxes, and insurance, often called PITI, plus your other operating expenses. Things like setting aside money for maintenance, potential repairs, and factoring in a cushion for when a unit might be empty for a bit.
Wait, so you mean the tenants are essentially paying for your housing costs and the cost of owning this investment property?
Ideally, yes. That's the goal. One source pointed out that the potential for rental income to cover all ownership expenses, including an allowance for vacancy, is really the ultimate aim. If you hit that, your personal housing expense drops dramatically, maybe even to zero. And at the same time, you're building equity in the property because the mortgage is getting paid down mostly by your tenants, and you also benefit from any potential property appreciation over time.
That is incredible leverage. You're basically getting your living expenses covered while you acquire an asset that's hopefully going up in value.
It's a powerful financial accelerator, no doubt.
Right.
One of the sources we looked at breaks down a couple of classic types. You've got the single-family home roommate scenario. Pretty simple. You buy a house, rent out the spare bedrooms. The main trade-off there is privacy, right? You're living in close quarters with your tenants.
Yeah, got to be comfortable sharing the kitchen, maybe.
Exactly, but the financial benefit can be huge. That source gave an example where, say, your total housing cost is $3,200 a month. If you have 3 roommates each paying $1,000, suddenly your personal out-of-pocket housing expense is only $200 a month. That's a phenomenal saving.
Yeah, the price of remembering to wear pants to the kitchen is significantly reduced housing costs. Seems like a fair trade for some.
Right. And then there's the multifamily approach. So buying a duplex, triplex, or fourplex, you live in one unit, rent out the others. This generally offers more separation and privacy than the roommate model, but the core financial principle is exactly the same. Live in one, rent the rest, and aim to have the tenants cover most, if not all, of the costs.
Okay, so it builds equity fast, gives you real landlord experience right away, and drastically cuts or even eliminates your personal housing bill. What are the downsides? What are the risks involved?
Well, the most obvious one is just the reality of living with tenants or having them right next door. It means managing personalities, setting boundaries, dealing with noise, handling maintenance requests. One source specifically mentions tenant risk, dealing with late rent, potential property damage, or just difficult people. It happens.
And vacancy risk seems critical here, too. If a unit sits empty longer than you budgeted for, that hole in your projected rental income comes directly out of your pocket, right? It messes up the whole calculation you relied on.
Precisely. Which can lead directly to the risk of negative cash flow. That's where the income you're bringing in simply doesn't cover all the expenses, and you find yourself having to subsidize the property from your personal funds. You absolutely need realistic income projections and a financial buffer just in case.
Now, that Forbes article on house hacking brought up something really interesting about protecting yourself legally, specifically using an LLC. Can you unpack that?
Yes, this is a really important nuance. Setting up a limited liability company, an LLC, to actually hold the title to the property is often recommended for asset protection. The idea is it helps create a legal separation between you personally and the property itself. So if a tenant were to, say, slip and fall and decide to sue, the lawsuit would theoretically be against the LLC, potentially shielding your other personal assets like your savings or another property.
Okay, that makes sense for liability protection. But the source mentioned a specific tax consideration that's crucial for house hacking.
Yes, and this is where it gets really interesting, and it really highlights the need for careful planning, maybe even professional advice. When you house hack, part of the property is your personal primary residence, right? But the other part is essentially a rental business. Now, if you structure the LLC for tax purposes as a partnership, which can be a common default if there's more than one owner, or based on certain tax elections, you could accidentally disqualify yourself from using a very valuable tax break down the road, the Section 121 exclusion on the sale of your primary residence.
The Section 121 exclusion. Remind me, that's the one that lets you exclude a big chunk of capital gains tax when you sell your main home.
Correct. For single folks, it allows you to exclude up to $250,000 of profit from taxes. And for married couples filing jointly, it's up to a whopping $500,000, provided you've owned and lived in the property as your main home for at least 2 out of the last 5 years before the sale. That's a huge potential tax saving.
Wow. Yeah, losing that eligibility would be a significant financial hit when you eventually sell the property.
Absolutely enormous. So the key advice from that source was this. Consider structuring the LLC as a disregarded entity for tax purposes if you're the sole owner. Or potentially explore an S-Corp or C-Corp election depending on your overall financial picture and what your tax advisor recommends. A disregarded entity basically means the IRS ignores the LLC for income tax purposes. They treat the income and expenses as if they flowed directly to you personally. The structure allows the part of the property that is your residence to still qualify for that valuable Section 121 exclusion when you sell, while the LLC structure itself still provides that layer of legal liability protection. What's fascinating is precisely that intersection. You've got legal protection needing one structure and tax benefits potentially favoring another view. You have to navigate both very carefully.
That tax detail is absolutely vital. Getting that wrong could cost you hundreds of thousands in taxes later. Okay, so house hacking. Powerful strategy, low initial costs using owner-occupied loans and tenant income, builds equity, saves on living costs, but definitely demands careful management, dealing with tenants, and very specific tax structuring if you use an LLC. High hustle, potentially high reward.
It certainly requires you to wear multiple hats, that's for sure.
All right, let's move to strategy number 2. This is kind of a variation on the theme of using your living situation, maybe slightly less intense on the day-to-day living with your tenants front. Live in, then rent.
Right. This approach involves buying a property that you intend to eventually turn into a full rental property, but you start by actually living in it yourself as your primary residence for a certain period first.
So you're intentionally buying a house that maybe fits your future investment goals, but you make it your actual home first.
Exactly. And the why little no money mechanism is essentially the same as house hacking. Because you're occupying the property initially, you qualify for that favorable owner-occupied financing, maybe the FHA loan with its 3.5% minimum down, or the VA loan potentially at 0%. You get a significantly lower required down payment and typically a better interest rate compared to buying it as a non-owner-occupied investment property right from day one. One source noted that investment property rates are generally at least 0.5% higher, sometimes quite a bit more.
Okay, so you live there for, what, maybe a couple of years, long enough to satisfy the owner occupancy requirements for the loan, and maybe also qualify for that Section 121 tax exclusion we just talked about if you sell later.
Yeah.
You build some equity, you make a few improvements while you're living there, and then you just move out, but keep the property.
Correct. You then convert it into a rental property. The beauty is you often get to keep the potentially much lower interest rate you secured with your original owner-occupied loan. The rental income you collect then helps cover, or potentially fully covers, the mortgage and expenses while you've moved on to your next primary residence, which, by the way, could potentially be another property you plan to use the same live-in then rent strategy on.
Huh. This seems like a systematic way to acquire rental properties one by one, with a significantly lower initial cost and better financing terms than if you just tried to save up 20% or 25% down for every single rental property you wanted to buy outright.
It absolutely is. It strategically uses your personal need for housing as the vehicle to access preferential financing for what will eventually become a purely investment asset. The mortgage report source did mention you might need to write a letter to your lender when you move out, just explaining that you intend to keep the property and rent it to satisfy their documentation requirements. But generally, it's a well-trodden path.
It's a really smart way to kind of blend your personal living needs with your long-term investment strategy.
It definitely allows you to start building that portfolio without needing a huge pile of cash up front for every single acquisition.
Okay, strategy number 3 brings in the hammers and paintbrushes. Live in house flips.
Yeah, this strategy is definitely not for the faint of heart, or maybe for those who really cherish living in pristine, finished conditions all the time. The idea is you buy a property, typically a fixer-upper that needs quite a bit of work, and you actually live in it while you're doing the renovations. The end goal here isn't usually to hold it long-term as a rental, but rather to renovate it fairly quickly and then sell it for a profit.
So the no money part here is, well, it's relative, isn't it? You still definitely need money for the initial purchase and the renovation materials, probably quite a bit. But you're saving money by not paying rent or another mortgage somewhere else while the renovation project is underway.
Exactly. Your living expense is essentially rolled into the project itself. And crucially, you're investing your own time and labor, your sweat equity, into the renovations. This can significantly reduce the amount of actual cash you need to spend paying contractors to do the work. So the why little no money aspect is really about substituting your personal effort and saving on those external housing costs to lower the overall capital burden compared to a non-owner occupied flip where you would need the purchase funds plus all the renovation funds plus pay for your own separate housing costs during the entire project.
Your DIY skills, or maybe just your willingness to learn and put in the effort, become a form of capital in this case.
Precisely. The potential benefits can be substantial profit if you execute the renovation well and the market cooperates, especially if your sweat equity saves you tens of thousands in labor costs. And again, if you meet the ownership and residency time requirements living there long enough, you can potentially use that powerful Section 121 exclusion to shelter a large portion of your profit from capital gains taxes when you sell.
So that big tax benefit keeps popping up with these owner-occupied strategies, the major factor. What are the big risks and challenges with a live-in flip? Sounds like a lot could go wrong.
Oh, significant ones for sure. First, you either need pretty strong renovation skills yourself, or you need reliable access to skilled contractors you trust, and crucially, you need the ability to accurately estimate repair costs up front.
Yeah.
This is where repair risk can bite you hard. Unexpected problems, finding faulty plumbing behind a wall, hidden electrical issues, unexpected structural problems can quickly blow your budget and your timeline completely out of the water.
And just, well, living in a construction zone for months on end sounds like a personal challenge too. Dust everywhere.
It is. It takes a certain personality, or at least a high tolerance for disruption. And you absolutely must understand the local market value specifically, the after repair value, or ARV. You need to make sure your renovation plans align with what buyers in that specific neighborhood are actually looking for and willing to pay a premium for. As one source put it quite well, you need to improve to sell, not for personal taste. Over-improving for the area or making renovations that just don't appeal to the target buyer pool can easily eat up all your potential profit.
Right. No gold-plated toilets if the neighbors have standard ones.
Exactly. And you also have to comply with the owner occupancy period requirements for your loan type and potentially for that tax exclusion. That usually means you can't just finish the renovation in, say, 3 months and immediately sell it, unless perhaps you use specific, often more expensive short-term financing designed purely for flips, not standard owner-occupied loans.
Okay, so this strategy requires significant capital upfront for the purchase and the initial renovation costs, a very high tolerance for living in mess and disruption, solid renovation know-how or access to it, and really sharp market analysis to make sure the project will actually be profitable in the end. The sweat equity helps lower the total capital needed compared to hiring everything out, but it's definitely not a zero cash way to get started.
Right. It heavily leverages your personal resources, your time, your skills, your tolerance for sawdust, rather than just relying on liquid cash.
All right, let's shift gears completely now. Moving away from leveraging your own living situation, let's move into Section 2. Strategies that primarily leverage other people's capital. This is really about getting involved in real estate investing by utilizing funds from other investors or institutions, sometimes without even needing to own the physical property outright yourself.
Yeah, this category often appeals more to folks who want to be more passive investors or maybe people who just want exposure to the real estate asset class without taking on all the direct responsibilities of being a property owner or a landlord.
Okay, strategy number 4, real estate crowdfunding. This was also mentioned in one source as a type of creative financing. What's the deal here?
Yes, crowdfunding platforms have really popped up in recent years as a way for lots of smaller investors to basically pool their money together online to fund much larger real estate projects. These could be things like commercial developments, big apartment buildings, or even portfolios of single-family rental homes that are all professionally managed by a central company.
How does this work for someone who doesn't have a lot of money to invest?
Well, that's the beauty of it. These platforms significantly lower the barrier to entry. Instead of needing, hundreds of thousands or even millions to participate in a large deal directly, you can often invest relatively small amounts. Some platforms we saw mentioned have minimum investments as low as $10. Fundrise was one example cited. Essentially, you become a fractional owner in a specific project, or maybe in a larger pool of projects. Or sometimes you're effectively lending money to a real estate developer and receiving interest payments back.
So you're not buying an entire office building yourself. You're buying a tiny slice of the financial structure related to that building, or maybe a whole portfolio of properties.
Exactly. It gives you access to larger, potentially more sophisticated real estate deals that you could probably never fund on your own. It offers diversification pretty easily across different projects, different types of properties like retail, office, industrial, residential, and often across different geographic locations too, which helps spread your risk. And it's typically a very passive investment. Professionals handle the property management, the project development, all of that. You, as the investor, just receive returns. These often come quarterly and can be a mix of income, like dividends. Fundrise was mentioned as historically earning around 8–9% before their 1% annual fee, and potential appreciation in the value of the underlying assets. Other platforms mentioned were Arrived Homes, which lets you buy shares in individual rental properties, and Happy Nest, focusing more on commercial real estate. Even platforms like Roofstock came up, although that seems more geared towards buying an entire turnkey rental property online, which usually requires significantly more capital than these fractional models.
Okay, so the benefits seem clear. Low barrier to entry, access to potentially large or professionally managed deals, easy diversification, passive income potential. What are the drawbacks or risks?
Well, the primary drawback is control. You have very little, if any, direct control over the investment decisions or the day-to-day management of the property. You're really relying entirely on the expertise, the track record, and frankly, the integrity of the platform itself and the developers or managers they choose to partner with. There's also platform risk. What happens if the company running the crowdfunding portal goes under? And liquidity risk is a big one. While it's easier to get into these investments than buying a whole property, getting your money out quickly isn't always easy. These are typically not as liquid as, say, a publicly traded stock or a REIT. You might face restrictions on withdrawals, penalties for exiting early, or you might have to wait for the underlying project to sell.
So it's a way to add real estate exposure to your investment portfolio without the landlord headaches, maybe starting with just pocket change. But you definitely trade away control and easy liquidity for that convenience.
It absolutely democratizes access to certain types of real estate investments that were previously off limits to most individuals.
Okay, closely related to crowdfunding, and maybe even more accessible for many, is strategy number 5. Investing in real estate investment trusts, or REITs. The Near Right source we looked at had some excellent detail on these.
Right. REITs are basically companies that own, operate, or sometimes finance income-producing real estate. They operate across a huge spectrum of sectors. Think apartment buildings, shopping malls, office towers, hotels, industrial warehouses, data centers, healthcare facilities, even things like timberlands or cell phone towers. The key is that they pool capital from countless investors, just like a mutual fund does, to acquire and manage these large portfolios of real estate assets.
And the little or no money angle here, how does that work?
Well, most REITs, especially the large ones, are traded on major stock exchanges, just like regular stocks, think Apple or Microsoft. So you invest simply by buying shares of the REIT. This means you can usually buy shares through any standard brokerage account or through mutual funds or exchange-traded funds, ETFs, that specialize in REITs. And importantly, you can often hold these in your retirement accounts like IRAs, 401k, or the government's TSP, which the narrate source specifically highlighted. You don't own the physical property directly. You own shares in the company that owns potentially hundreds or thousands of properties. Minimum investments can be extremely low, potentially just the price of a single share, which could be $20, $50, $50. Or if you're investing via a fund, maybe a few $100s, like the $500 minimum mentioned for a Fundrise REIT, or even less now with many brokerages offering fractional share investing.
So if I can afford to buy a share of common stock in a tech company for, say, $50, I could probably buy a share in a company that owns a bunch of shopping malls or apartment complexes for a similar amount.
Exactly. The accessibility is incredibly high. And the narrate source pointed out several major benefits. First, high liquidity. Because most REITs trade on public stock exchanges, you can generally buy and sell your shares easily during market hours, which is a stark contrast to physical property or even many crowdfunding investments. Second, diversification. A single REIT share gives you instant exposure to a potentially vast portfolio of properties, often spread across different locations and property types. And third, passive income. REITs have a special legal structure that requires them to distribute a large percentage of their taxable income, typically at least 90% back to shareholders in the form of dividends each year. This often results in relatively high dividend yields compared to many other stocks.
Yeah, that high dividend yield is often a major attraction for income-focused investors. And didn't NORAD also mention something about them historically having a low correlation with the broader stock market?
Yes, that's another potential diversification benefit for your overall investment portfolio. Because REIT performance is tied to the underlying real estate assets as much as the stock market, adding them to a mix of stocks and bonds can potentially help reduce the overall volatility of your portfolio. Narrate actually suggested an optimal allocation of somewhere between 5% and 15% of your total portfolio towards diversified real estate, potentially through REITs, for this reason.
Okay, they sound like a very accessible, very liquid, and highly diversified way to get exposure to real estate without any of the property management hassles. What are the risks with REITs?
Well, they are still subject to market risk. Their share prices fluctuate daily with the overall stock market sentiment and also with the perceived health of the specific real estate sectors they invest in. For example, if people worry about online shopping hurting malls, retail REITs might suffer. Performance also obviously depends heavily on the quality of the REIT's management team and their decisions. And one important distinction, while publicly listed REITs are highly liquid, you should be aware that there are also public non-listed REITs and completely private REITs out there, and those are generally much less liquid and harder to sell quickly, so you need to know what you're buying.
But compared to actually owning a physical property, that ability to just click a button and buy or sell shares pretty much instantly on an exchange is a huge difference in liquidity.
It's a very significant advantage for investors who prioritize ease of entry and, just as importantly, ease of exit.
All right, let's switch gears again and look at strategy number 6. This takes a different and maybe more controversial approach to finding that initial capital. Borrow your down payment.
Yeah, the source material, particularly money-wise, was quite direct about this one, and it comes with a pretty strong warning label attached. It explicitly calls the idea of borrowing 100% of the money needed to buy a home risky, and it even draws parallels to some of the lending practices that contributed to the 2008 housing bubble.
Oof. Okay, that's a serious cautionary note right off the bat. Why is it considered so risky, and how do people even attempt this if lenders usually require you to prove you have your own funds for a down payment?
Right. So traditional mortgage lenders generally have pretty strict rules about where your down payment money comes from. They usually require the funds to be seasoned, meaning they've been sitting in your bank account for a while, maybe 60 to 90 days, and they need to originate from acceptable sources. That typically means your own savings, documented gifts from close family members, or certain approved down payment assistance programs. They explicitly prohibit borrowing your down payment using another loan because, quite simply, it increases your overall debt burden and your financial risk, your leverage risk goes way up.
Okay, so any methods people use to effectively borrow their down payment are essentially workarounds, right? They're trying to satisfy the letter of the lender's rule, maybe, but perhaps not the spirit behind it.
Precisely. They're trying to make borrowed money look like it wasn't borrowed. The MoneyWise source mentioned a couple of ways people sometimes attempt this. One method is borrowing from your own 401k retirement account. You're essentially taking a loan against your retirement savings.
So you're taking money out of your future retirement bucket to put it into a house today, basically.
Yes. Now, from a mortgage qualification perspective, sometimes lenders might not count the repayment of a 401k loan against your debt-to-income ratio, your DTI, because technically you're paying yourself back. However, the risks here are substantial. First, you're depleting your retirement savings, which could seriously impact your financial future down the road. Second, if you leave your employer for any reason, get laid off, change jobs, you often have to repay that 401k loan very quickly, sometimes within 60 days. If you can't, it's often treated as an early withdrawal, potentially triggering significant income taxes and penalties. This introduces huge leverage risk and ties up your crucial retirement funds in a potentially illiquid real estate investment.
Yeah, that sounds incredibly risky for your long-term financial security. Doesn't seem worth it unless you're really stuck.
It's definitely a move to consider very, very carefully. The other method mentioned involves taking out a separate personal loan, or maybe using a home equity line of credit, HELOC, on another property if you have one, or even cash advances from credit cards, though that's extremely expensive. Then you deposit those borrowed funds into your bank account.
Okay, and this is where that seasoning idea comes in again.
Exactly. The strategy here is to let those borrowed funds sit in your regular bank account for a few months, typically at least 60 to 90 days, though the specific time frame can vary by lender and loan program. The idea is that when the mortgage underwriter reviews your bank statements for the loan application, they'll see the funds have been in the account for a while. They won't see a recent large deposit that screams borrowed money. If the funds look like they've been there long enough, the lender might accept them as your own funds available for the down payment and closing costs.
So you're basically trying to make borrowed money look like saved money just by letting it sit there for a bit.
That's the attempt, yes. But again, the source was crystal clear. This is risky. You are still taking on significant additional debt, that personal loan or the HEO loans or the credit card balance on top of the new mortgage you're trying to get. This massively increases your overall debt load and your leverage risk. If the real estate investment doesn't perform as you expected, or if you face unexpected job loss or big expenses, you now have multiple significant debt obligations you have to somehow keep servicing. It can become a house of cards very quickly.
Yeah, the source's explicit warning, something like, lenders will tell you cannot borrow your down payment, really underlines that these are methods to be approached with extreme caution. They seem to circumvent standard lending practices and could load you up with potentially crippling debt if anything goes wrong.
It's definitely operating in a gray area, and it's on the higher risk end of the spectrum.
Yeah.
It relies more on financial maneuvering rather than having accumulated capital or generating value through the property itself initially.
Okay, let's explore a couple more types of financing that fall under that creative umbrella, things mentioned in sources like the Creative Real Estate Financing Guide that can help access capital outside of the traditional big banks. First up, private money lenders and hard money loans.
Right. So these are funding sources that come from individuals or maybe specialized companies that are not your typical banks or mortgage institutions. They operate outside the highly regulated world of conventional lending.
How do they work differently? And how might they help someone who maybe can't qualify for a traditional loan because they don't have a big down payment or their credit isn't perfect?
The key difference lies in their basis for approving a loan. While traditional banks focus very heavily on your personal creditworthiness, your credit score, your income history, your debt-to-income ratio, private money lenders and hard money lenders primarily focus on the value of the property that's being used as collateral. It's asset-based lending. They look at the property's current value and, maybe more importantly, especially for renovation projects, its potential after-repair value, or ARV. This can make funding potentially accessible even if you don't have pristine credit or can't document income perfectly, because the lender's main security is the property itself, the hard asset.
Interesting. So if you manage to find a fantastic deal on a property, say it's significantly undervalued but has really strong potential after repairs, you might be able to get funding based largely on the deal's merit, even if your personal financial profile isn't quite strong enough for a bank.
That's the idea. As one source noted, they are collateral-driven. These types of loans are very commonly used for short-term projects, particularly house flips, where the borrower intends to buy, renovate, and sell the property relatively quickly. Loan terms are therefore often very short, maybe just 4 to 6 months, sometimes up to a year or maybe slightly longer, but definitely not the 30-year terms you see with conventional mortgages.
Okay, what are the trade-offs? Why doesn't everyone just use hard money if it's easier to qualify based on the property?
The cost is significantly higher than traditional financing. Interest rates are much, much higher, often well into the double digits, think 10%, 12%, 15%, or even more annually. On top of the high interest rate, they also usually charge points upfront. A point is typically 1% of the total loan amount, and lenders might charge anywhere from 1 to 5 points or more just to originate the loan. So 3 points on a $100,000 loan means you pay a $3,000 fee right at the beginning. And while the required down payment might be lower than a traditional investment property loan, it's usually not zero. A hard money lender might lend, say, up to 65% or 75% of the property's after repair value. That still means you, the borrower, need to come up with the remaining percentage to cover the purchase price difference, plus closing costs, plus all the renovation funds yourself.
Wow. High interest rates, significant upfront fees, short repayment terms. Sounds like a lot of pressure.
It absolutely is. The high cost and the short repayment window mean you need an extremely solid, executable plan right from day one. There's very little room for error or delays. The risk of losing the property to the lender is significant if you can't complete the renovation and either sell the property or refinance into a longer-term loan before that hard money loan term expires. One source also mentioned that some hard money lenders might even require additional collateral beyond the subject property, like equity you have in another property you own, further increasing your risk. And generally, these loans are less regulated than traditional bank loans, so the terms can be less borrower-friendly.
Okay, so they're definitely a tool, a way to access capital based more on a deal's potential than your personal finances, but they are expensive, high risk, and probably best suited for experienced investors who have very clear exit strategy and a high degree of confidence they can execute their plan very quickly.
They finance the deal more than they finance the borrower, but they absolutely come at a premium price and carry significant risk.
Got it. Another powerful way mentioned to leverage other people's capital, and also often listed as a type of creative financing, is forming joint ventures. What does that entail?
Right. So joint ventures, or JVs, in real estate basically involve two or more individuals, or maybe even companies, teaming up to pool their resources together for a specific real estate project or deal.
How does this help someone who has little or no cash to bring to the table?
This is where the synergy happens. You might be the person who has the skills, the time, or the knowledge, but you lack the capital. So you partner with someone who does have the capital but maybe lacks the time, the deal-finding ability, or the renovation expertise. You bring other valuable resources to the partnership. This could be your knack for finding great off-market deals, the deal flow. It could be your deep knowledge of a specific local market. It could be your construction or renovation expertise providing sweat equity. Or maybe it's your property management skills.
So instead of one person needing to have all the cash, all the skills, and all the time, you combine different people's strengths to make the deal happen.
Exactly. As described in some sources, it's like teaming up. One partner might bring the financial backing, the cash. The other partner brings the execution capability, the know-how, the hustle. This structure allows both parties to participate in deals that maybe neither of them could do entirely on their own. You can potentially access larger, more profitable projects. You share the financial burden up front, and you also mitigate risk because it's spread across the partners. Profits and losses are then shared based on an agreed-upon structure that reflects each partner's contribution, whether that contribution was cash, time, expertise, or finding the deal.
It sounds like a really natural fit if you have the hustle, the knowledge, or the skills, but you're just lacking that initial capital injection. What are the potential downsides or things you really need to watch out for when setting up a JV?
This strategy absolutely, positively requires clear, comprehensive, and legally sound agreements drawn up right from the very beginning. You need to explicitly define everything. Each partner's specific roles and responsibilities, their financial contributions, cash, loans, guarantees, exactly how profits and losses will be calculated and distributed, who has decision-making authority on different matters, and crucially, clear exit strategies. What happens if one partner wants out early? What happens if the project goes sideways? What are the terms for dissolving the venture? Potential for disputes is incredibly high if expectations and responsibilities aren't crystal clear and documented legally from the start.
And sharing control also means you lose some of that unilateral decision-making power you'd have if you were investing alone.
Yes, absolutely. Important decisions typically require agreement among all the partners, which can sometimes slow things down or lead to compromises. And the Creative Real Estate Financing Guide specifically added a note of caution about entering into joint ventures with close friends or family members. While it can work, financial disagreements have a nasty habit of putting a significant strain on personal relationships. So you need to go in with eyes wide open and maintain professional boundaries.
That's very sound advice. Mixing money and close personal connections always requires extra diligence and super clear professional agreement.
It's a powerful way to overcome the capital barrier by leveraging relationships and diverse skill sets. But getting the human element and the legal structure right is absolutely critical for success and sanity.
All right, let's transition now to Section 3. These are strategies that primarily leverage hustle, knowledge, and deal structure. These methods aim to minimize the need for traditional capital by relying heavily on your ability to find great opportunities and structure the transactions in creative ways.
Yeah, these are often very active strategies. They require significant effort, networking, and market savviness upfront, but they can indeed be started with very little, sometimes practically zero, personal financial outlay.
Okay, strategy number 8. Wholesale properties to investors. What is wholesaling?
Wholesaling is essentially acting as a middleman or maybe a matchmaker in real estate transactions. Your job is to find distressed properties. These are often houses needing significant repairs or properties owned by highly motivated sellers. Think people facing foreclosure, dealing with an inherited property they don't want, probate, or landlords who are just tired and want out. You find these properties, negotiate a purchase price that's significantly below the current market value, and you get the property under contract. But here's the key. Your goal isn't to actually buy it yourself. Your goal is to quickly find another investor, typically a house flipper who wants to renovate and resell it, or maybe a buy-and-hold landlord looking for a new rental property, and then you sell or assign your purchase contract to them for a fee.
Okay, wait. So you never actually buy the property yourself. You never take title, never have to get a mortgage, never have to swing a hammer or deal with tenants. You're basically just selling the right to buy the property that you secured under contract.
Exactly. That's the core of it. The why little to no money aspect is precisely that. You don't need a down payment. You don't need renovation funds. You don't even need to qualify for a loan to close on the property in most cases. Your profit comes entirely from the fee you charge the end buyer, the flipper or landlord, for assigning them your rights under the purchase contract. Sources mentioned typical wholesaler assignment fees ranging anywhere from $5,000 to $15,000, and sometimes significantly more, even up to $25,000 or $30,000 on really good deals where there's a lot of profit potential for the end buyer.
Wow. Okay, that sounds like it requires some serious effort, though, to find those motivated sellers and find the investors willing to pay that fee.
It absolutely does. The hustle part is primarily in lead generation, finding those deals and negotiation. One source, Deal Machine, gave some insights into how wholesalers find these opportunities. Things like driving for dollars, which literally means driving around neighborhoods looking for houses that look distressed, vacant, or neglected. Also, targeted direct mail campaigns sent to specific homeowner lists, like absentee owners or people late on taxes, cold calling potential sellers, networking heavily with real estate agents, contractors, attorneys, and other investors. Using online lead generation services, it requires consistent marketing effort, which might involve a small budget for mailers or software tools, but it's absolutely minimal compared to the capital needed to actually buy a property.
What are the main benefits of taking this wholesale approach?
The biggest benefit is very low financial risk, simply because you're not actually buying or holding the property yourself for any length of time. You generally don't need loans, you don't have to deal with the headaches and costs of renovations, and you certainly don't manage tenants. It can be a relatively quick way to generate cash, although the income stream is often inconsistent. It's also an absolutely excellent way to learn your local real estate market inside and out, understanding values, repair costs, neighborhood trends, and to build a really valuable network of contacts with both sellers and active cash buyers. The Deal Machine source also mentioned a technique called a double closing or simultaneous closing, where if needed, you can facilitate the deal by scheduling 2 closings back-to-back on the same day. Use the end buyer's funds to close your purchase from the original seller and then immediately turn around and close the sale to the end buyer. This further minimizes your need for upfront capital.
So you're literally just acting as the conduit, passing the baton from the motivated seller to the ready investor, and taking a fee for making that connection and securing the deal at a good price initially. What are the risks involved in wholesaling?
The main risks are centered around knowledge and execution. You absolutely need strong market knowledge to accurately estimate the property's after repair value, ARV, and the likely renovation costs. This is crucial for determining what price constitutes a genuinely good deal for your end investor. If your numbers are off, you might get a property under contract, but then find you can't sell the contract because there isn't enough profit margin left for the flipper, and your deal could fall through, potentially costing you any earnest money deposit you put down. You need excellent negotiation skills, both with sellers and buyers. Finding reliable cash buyers who can actually close quickly is critical. Your reputation depends on it. And as mentioned, the income is highly inconsistent. It really relies on your ability to continually find and successfully assign deals. Plus, depending on your specific market, competition among wholesalers can be quite intense.
So your primary investment isn't money. It's your time, your effort, your market knowledge, and your communication and negotiation skills. High hustle, low capital requirement, but potentially volatile income.
It's essentially pure sales and deal making, just within the real estate context.
Okay, even lower risk, perhaps, and requiring even less financial input initially, is strategy number 9, being a bird dog.
Yeah, the term bird dog comes from hunting, right? The dog's job is just to find the birds and point them out to the hunter. In real estate, a bird dog does something similar. They find potential investment deals, usually distressed properties or signs of motivated sellers for other active investors like wholesalers or flippers, and they get paid a finder's fee if the investor successfully closes on that deal.
So as a bird dog, you're not even getting the property under contract yourself, you're just spotting potential opportunities.
Exactly. Your role is purely as a lead generator. You identify properties that look like they might be good investment opportunities, often by doing that same driving for dollars, looking for houses with boarded up windows, overgrown lawns, eviction notices, signs of neglect that might indicate a motivated seller. You gather some basic information, maybe snap some photos, jot down the address, perhaps do some preliminary online research if you can, and then you pass this lead along to an investor in your network who you know is actively buying properties in that area.
And if that investor pursues the lead and eventually buys the property based on the information you provided, they pay you a finder's fee.
That's the model. You get paid for bringing them a viable lead that turns into a closed deal. The MoneyWise source suggested a typical finder's fee might be around $1,000 per successful deal, although this is definitely negotiable and depends heavily on the quality of the lead you provide and the eventual profitability of the deal for the investor who buys it.
So this has got to be the ultimate no money down strategy, right?
Financially speaking, yes. Your capital requirement is effectively zero. The benefits are clear. It's the absolute lowest financial risk entry point into the real estate world. There are no contracts to sign, usually, no loans needed, no renovations to manage, no tenants to deal with. It's purely about observation, maybe a bit of investigation, and crucially, networking.
What are the main requirements or risks then, if any?
Well, you need to develop a keen eye for what actually constitutes a potential deal in your specific market. It's not just any old house. You need to learn to recognize the signs of distress or potential seller motivation that experienced investors look for. And you absolutely need to cultivate a network of active real estate investors, wholesalers, flippers, landlords who trust the quality of your leads and are genuinely willing to pay you a finder's fee for them. Your income potential is obviously limited to these relatively small finder's fees, which are much smaller than what a wholesaler or flipper might make on the same deal. And your income is entirely dependent on the investors you work with actually being able to close the deals you find for them. If they can't perform, you don't get paid, even if it was a great lead.
So it's pure lead generation and networking. Requires really keen observation skills and the ability to build solid relationships with active buyers.
Your knowledge of what those specific investors are looking for becomes your primary asset in this role.
Okay, let's circle back slightly to strategy number 7, which we listed earlier, but it fits logically here in this section focused on creative deal structuring. This is the master lease option, MLO.
Right. The MLO is generally a more complex strategy, and it's often applied to larger properties. Think small apartment buildings, maybe commercial properties, rather than single-family homes typically. It involves 2 key components. First, you enter into a lease agreement for the entire property from the owner. Second, combined with that lease, you secure an option agreement that gives you the exclusive right, but not the obligation, to purchase the property at a pre-agreed price within a specific time frame, maybe 3 to 5 years out.
Okay, so you don't actually own the property yet, but you gain operational control over it through the master lease.
Correct. You effectively step into the owner's shoes in terms of managing the property. You find the tenants for the individual units, you collect the rent, and you become responsible for paying all the property's operating expenses. This typically includes covering the owner's underlying mortgage payments, the property taxes, the insurance, and all the maintenance and repairs. As part of the agreement, you also pay a pre-negotiated lease payment directly to the owner, which might be a fixed amount each month or perhaps a percentage of the rents you collect.
And the why little no money initially part, how does that work?
You gain control of a potentially valuable income-producing asset without having to come up with the enormous capital sum that would be required to purchase it outright today. Your initial costs might involve paying an option fee to the owner for securing that right to purchase later. This fee might be non-refundable, or sometimes it can be credited towards the purchase price if you exercise the option. You might also need some upfront working capital for minor repairs, marketing to find tenants, or covering initial operating costs. But typically, these upfront costs are far, far less than a traditional down payment on a property of that size. Then, ideally, you generate positive cash flow from operating the property. The difference between the total rent you collect from all the tenants and all the expenses you pay out, including the owner's mortgage and your lease payment to them. This cash flow can build up over the term of the lease.
And that accumulated cash flow, maybe combined with market appreciation or improvements you make that increase the property's value, helps you eventually gather the funds needed to exercise your option to buy the property at that pre-agreed price.
That's precisely the goal. The positive cash flow you generate and save provides the funds you can use towards the down payment or full purchase price when you decide to exercise your option. One source mentioned the well-known story of investor Brandon Turner using an MLO to get control of an apartment building early in his career. He apparently saved up the rent differential over time to eventually buy the property. Importantly, no ownership title actually transfers to you during the lease term. You just have operational control and the contractual right to buy it later.
So you're essentially leveraging operational control and future purchase rights, funded primarily by the property's own income stream, to get into a larger deal you couldn't possibly afford to buy conventionally today. What are the main risks or challenges with an MLO? Sounds complex.
It is a sophisticated strategy, no doubt. It requires really strong property management skills to ensure the property operates profitably and actually generates the positive cash flow you need to meet all your obligations and save up for the eventual purchase. Finding good tenants, managing vacancies effectively, and handling repair costs efficiently are absolutely crucial. The master lease and option agreements themselves need to be meticulously drafted by experienced attorneys to cover all possible contingencies. You also need to remember the owner still retains significant risk. If you fail to make the underlying mortgage payments or manage the property poorly, it's their credit and asset on the line, as the mortgage is still in their name. However, your purchase price is locked in by the option agreement, which does protect you from the risk of significant market appreciation driving the price way up before you're ready or able to buy.
This definitely requires significant operational know-how, careful financial management, and solid long-term planning. It's much more involved than just finding a distressed single-family house or connecting a seller with a buyer.
It's really about controlling and operating an asset effectively over a period of time with the ultimate goal of acquiring ownership down the road.
Okay, now we absolutely need to address a strategy that, based on our sources, particularly the Reddit thread we reviewed, sparks intense debate and seems to carry significant, even severe risks, especially for one party involved. This is subject to investing.
Yes. Subject to investing, often called sub-2, is a method of acquiring property where the buyer takes over the ownership, they get the deed, and starts making payments on the seller's existing mortgage. Here's the critical part. The mortgage itself, the actual loan obligation, remains legally in the original seller's name and continues to show up on their credit report.
Okay, let me make sure I understand that because it sounds unusual. The buyer owns the house, the title, the deed is in their name, but the seller is still the person legally on the hook with the bank for the mortgage.
Precisely. That's the defining characteristic. The buyer takes possession, manages the property, and hopefully makes the monthly mortgage payments directly to the lender, but the original loan documentation and the ultimate legal responsibility for that debt remain tied to the seller. The primary appeal for the buyer is that they can acquire the property without having to qualify for a new mortgage themselves. This can potentially allow them to bypass the often lengthy and stringent loan application process, avoid many closing costs associated with a new loan, and, perhaps most importantly, get into the property without needing a traditional large down payment. The upfront payment made to the seller, if any, might be much smaller than a standard down payment, maybe just enough to cover whatever small amount of equity the seller has, plus the closing costs for the deed transfer.
Okay, so for a buyer, particularly one who might have trouble qualifying for a conventional mortgage due to credit issues or lack of documented income, it can seem like a much faster, lower-cost way into property ownership.
That's certainly the potential benefit often highlighted for the buyer. Proponents of the strategy might also list some potential benefits for the seller, especially a distressed seller. They might be able to sell the property quickly when they otherwise couldn't, perhaps walk away with a small amount of cash if they have very limited equity, or in a difficult situation like facing foreclosure, maybe avoid the immediate credit damage and costs associated with the foreclosure process itself.
Based on the tone and the specific stories shared in that Reddit thread, the risks for the seller seem absolutely enormous, and apparently they frequently materialize in really painful ways. We need to be incredibly clear about these warnings, as the source material was full of them.
Yes. The discussion we found in that Reddit thread serves as a very powerful, almost visceral counterpoint to any perceived seller benefits. It was overwhelmingly dominated by negative experiences and strong warnings for the seller. The first and most critical risk, the one that underpins everything else, is that the seller remains 100% legally responsible for that mortgage. Even though they no longer own the house, that debt is still on their credit report, it's still their legal obligation, and it significantly impacts their debt-to-income DTI ratio calculation.
Wow. Even after they've signed over the deed and someone else is living there and supposedly making the payments.
Correct. And this leads directly to the second major risk, which was tragically illustrated by multiple, quite detailed user anecdotes in that Reddit thread. The seller will likely face extreme difficulty or find it completely impossible to get a new mortgage for themselves in the future. We read accounts from people who were denied new home loans years after doing a subject to deal, even when they had a good income, good credit scores otherwise, simply because that old mortgage, still showing up in their name on their credit report, made their DTI too high in the eyes of new mortgage lenders. This isn't a short-term blip. It can be a long-lasting, significant consequence that prevents them from moving on with their own lives.
That is a potentially devastating outcome if you ever want to buy another home for yourself, or even refinance a different property you own, just completely stuck.
It's a massive, often completely unexpected, long-term hurdle that was highlighted repeatedly and forcefully in that source. Third, and perhaps most terrifyingly, there's significant default risk. If the buyer, for any reason whatsoever, they lose their job, they turn out to be irresponsible or unscrupulous, the property needs major repairs they can't afford, it becomes vacant and they stop paying, if they start making those mortgage payments, it's the seller's credit that is immediately ruined by the missed payments reported to the credit bureaus. The lender won't pursue the buyer initially. They will pursue the seller for the debt because the seller is still the legal borrower. Or they'll initiate foreclosure proceedings against the property, which is now owned by the buyer, and against the seller whose name is on the loan.
So the seller is completely on the hook, financially and reputationally, for the buyer's potential failure or irresponsibility.
Absolutely, 100%. One user in the thread mentioned the theoretical protection of having a deed in lieu of foreclosure agreement, or maybe a performance deed prepared up front, which supposedly allows the seller to get the house back relatively easily if the buyer defaults. However, the sheer weight and severity of the negative experiences shared strongly suggests that this type of protection is often insufficient, difficult, or slow to enforce compared to the immediate and severe damage already done to the seller's credit rating and overall financial standing once payments are missed.
And doesn't this whole strategy also brush up against the due on sale clause that most mortgages have?
Yes, this is another major lurking risk in the background. Most conventional mortgages contain a standard due on sale clause. This clause explicitly gives the lender the right to demand the immediate repayment of the entire outstanding loan balance if the property is sold or ownership is transferred without the lender's prior written consent. Doing a subjective transaction almost always involves not notifying the lender about the transfer of ownership, because if they were notified, they would typically require the new buyer to formally assume the loan or qualify for a brand new loan anyway, which defeats the purpose for the buyer. While one Reddit user claimed that experienced lawyers can structure and close these deals in a way that isn't fraudulent, the reality is that circumventing the lender's knowledge and consent is inherent to the strategy's appeal for the buyer. And it means the lender could, technically, discover the ownership transfer at any time, maybe when the insurance policy changes name, or through public records and decide to exercise their right to call the note due, demanding full and immediate repayment. This would put both the buyer and the seller in an immediate, potentially catastrophic financial bind with potentially no easy way out.
So the bottom line here seems to be that while Subject 2 might be pitched by some investors or gurus as a flexible or easy option, especially for buyers struggling to qualify conventionally or for sellers in distress, the overwhelming message from the real-world experiences shared in that Reddit source is that it is extremely risky, perhaps even predatory for the seller, and it disproportionately benefits the buyer who assumes ownership without the corresponding debt responsibility initially.
That source makes the risks for the seller starkly, painfully clear. Based on that input, Subject 2 seems appropriate, if it's ever appropriate at all, only for sellers who are in truly dire straits, perhaps facing imminent foreclosure with absolutely no other viable options, maybe significantly underwater on their mortgage. And even then, only if they fully understand and explicitly accept the severe, potentially life-altering long-term risks to their credit score, their DTI ratio, and their future ability to obtain any kind of financing for potentially years to come. Presenting the conflicting views we saw in the thread, some people claiming it works fine if done correctly with experienced buyers and proper paperwork, versus others calling it legalized fraud based on their own ruined credit, is important for balance. But the severity and prevalence of the warnings for the seller cannot possibly be overstated, as they were the dominant and most impactful message coming from that real-world discussion.
It requires extreme caution, full transparency, and a complete, almost pessimistic understanding of the significant liabilities you are potentially leaving behind with the seller long after you've taken ownership.
Due diligence here is absolutely paramount, particularly ensuring the seller understands the full, unvarnished potential ramifications before agreeing to this type of deal.
Okay, well, let's shift now to Section 4, focusing on a strategy that is heavily rehab-focused and specifically designed for scaling a portfolio over time. The BRRRR method, this is an acronym, right, standing for Buy, Rehab, Rent, Refinance, Repeat.
That's right. BRRRR, often pronounced just like the cold sound, burr, is a very popular and powerful strategy for building a rental property portfolio, potentially quite quickly. However, it is absolutely crucial to understand right up front. This is not generally a no money down strategy, especially not for your first deal in the cycle.
Okay, so walk us through how it works and clarify why it typically requires significant initial capital to get started.
Sure. The process follows the acronym. First, you buy a distressed property, usually one that needs significant repairs, which allows you to purchase it at a discount compared to market value. Second, you rehab the property. You invest money and often time and effort to fix it up, bring it to a desirable rental standard, or maybe even better, thereby increasing its market value substantially. This is often called forcing appreciation. Third, once the renovation is complete, you rent it out to qualified tenants, turning it into an income-producing asset and stabilizing its operation. Fourth, after the property is rehabbed and rented, typically after a seasoning period required by lenders, maybe 6 months, you refinance the property. This is usually a cash-out refinance where you get a new, longer-term loan based on the property's higher after-repair value, ARV, not the original purchase price. Because the ARV is hopefully much higher than your total investment, purchase price plus rehab costs, you can often pull out a significant amount of tax-free cash equity from the property during this refinance. Fifth, you take that cash you pulled out from the refinance and you repeat the entire process using that money as the down payment and renovation funds for your next distressed property purchase.
Okay. So the goal is to use the equity you created through the forced depreciation, the value added by the rehab work, to fund your next acquisition and renovation. This allows you to scale your portfolio potentially without needing to save up a whole new chunk of personal savings for each subsequent deal.
Precisely. The equity harvested from completing one BRR cycle becomes the seed capital for starting the next one. But, and this is the critical point for people looking for truly no-money strategies, that very first step, the initial buy and rehab of the first property in your BR journey, requires a sizable chunk of startup money, as the MoneyWise source explicitly notes. Distressed properties, the kind ideal for BRR, often don't qualify for traditional mortgage financing, especially not owner-occupied loans if you don't plan to live there. Or they might require a much larger down payment, maybe 25–30% than a move-in ready home. You might even need to use more expensive short-term financing initially, like a hard money loan or private money we discussed earlier, just to acquire the property and fund the renovations. This adds significantly to that initial capital requirement before you can even get to the rent and refinance stages where you potentially recoup your investment.
Okay, so you really need the cash for the down payment on the initial purchase, plus enough funds to cover the entire renovation project, all before you can place a tenant or get that crucial refinancing done. That sounds like a pretty substantial upfront investment required just to get the first deal off the ground.
It typically is, yes. It's definitely not a strategy for someone starting with literally zero savings. But the benefit, once you get the first one done successfully and recoup your capital, is the potential to build a significant rental portfolio relatively quickly compared to saving up 20% down for each property individually. You also generate ongoing passive rental income from the properties once they're rented, and that cash-out refinance provides a way to access your built-up equity tax-free, as it's technically loan proceeds, to fund your continued growth.
What are the main risks and challenges involved with the BRRR strategy, beyond just needing that significant initial capital for the first deal?
Well, there's definitely a significant learning curve, especially in accurately estimating those renovation costs up front and correctly determining the true after-repair value, ARV, you can realistically expect to achieve in your specific market. Getting either of those wrong can kill the deal's profitability. Repair risk is huge with distressed properties. You often uncover unexpected, very expensive problems once you open up walls or start digging. You face all the standard landlord risks once the property is rented. Vacancy risk if it sits empty. Tenant risk if you get bad tenants who cause damage or don't pay. And there's always the risk of negative cash flow if your initial income projections were too optimistic or your expense estimates were too low. Or critically, if the refinance appraisal doesn't come in high enough. If the appraisal is lower than you projected, you might not be able to pull out enough cash to recoup your initial investment and fund the next deal, stalling your momentum. The MoneyWise source even pointed out potential specific tax implications in certain areas, giving Maryland as an example where you might end up paying transfer taxes or deed recording taxes twice, once on the initial purchase and again on the refinance transaction, which can significantly eat into your returns. You really need to research and confirm if the BRRR strategy is viable and tax efficient in your specific local market before diving in.
It sounds like a very powerful wealth-building strategy specifically designed for scaling a rental portfolio. But it absolutely requires significant initial capital for that first deal, deep market knowledge, especially regarding values and rehab costs, a high tolerance for renovation risk, and effective property management skills once it's rented. Definitely not an entry point for someone starting with absolutely zero savings.
It's often a strategy you transition into once you've already accumulated some capital, perhaps from a previous live-in flip or saving diligently, or maybe after gaining significant experience with renovations and property management through other means.
Which brings us nicely to our final section, maybe zooming out just a bit to look at the broader landscape of risk. We've touched on specific risks tied to each strategy as we went along, but it feels vital to understand the overall risk profile of real estate investing, especially when you're attempting to start with limited personal capital. The greatest risks source we consulted provided a really helpful framework here.
That's right. Investing in real estate, regardless of how you get started, always involves risk. There's no getting around that. And attempting to start with little or no money down often means you are using higher leverage, which can significantly amplify some of these inherent risks.
So what kind of overarching risks should someone contemplating these strategies really be aware of?
Well, the source broke them down into a few key categories. First, you have market risks. These are largely external factors related to the specific location of your investment, things mostly beyond your direct control. Location risk itself encompasses things like the health of the local economy, job growth, unemployment rates, crime rates in the neighborhood, or even environmental factors like being in a flood zone or an area prone to earthquakes or hurricanes, which can impact insurance costs and property desirability. Then there's legislative risk. This involves potential changes to local laws that could negatively impact your investment. Think changes to zoning regulations, the implementation or strengthening of rent control laws, new tenant protection laws that make evictions much harder or more costly, or significant increases in property taxes. All of these can unexpectedly hurt your cash flow or even the underlying value of your property.
Right. These are things happening around your property that you can't control, but which can definitely impact your bottom line.
Exactly. Then, closer to home, you have property risks. These are the risks directly associated with the physical asset and its operation, many of which we've touched on. Unexpected repair costs are a big one, especially with older properties or those bought in distressed condition. Vacancy periods, when the property sits empty between tenants, directly hit your income stream. Challenging tenants can lead to property damage, costly legal battles for eviction, or simple non-payment of rent. And underlying all of this is the potential for negative cash flow, where the property consistently costs you more to own and operate each month than it brings in through rent.
These feel like the day-to-day operational headaches and financial realities of being a direct property owner.
They certainly are. And finally, the source highlighted financial risks, which are particularly amplified when you're starting out with minimal personal capital invested. Leverage risk is absolutely paramount here. Using borrowed money debt magnifies both your potential gains and your potential losses. When you have very little or no actual equity in a property, either because you put very little cash down initially, or maybe you borrowed your down payment, even a relatively small dip in the property's market value, or one unexpected major repair, like needing a new roof, can potentially wipe out your thin equity entirely and leave you underwater, meaning you owe more on the loan than the property is currently worth. The source explicitly warned against becoming over-leveraged, suggesting perhaps aiming not to finance more than 70–75% of a property's value, although many of the low or no money down strategies we discussed necessarily involve much higher leverage, at least initially.
And the other big financial risk mentioned was liquidity risk.
Yes, this is fundamental to real estate as an asset class. Physical real estate is inherently an illiquid asset. Unlike stocks or REITs that you can usually sell within minutes or hours on an you suddenly need access to cash for some reason, maybe personal emergency, a job loss, or another investment opportunity. Selling a property typically takes weeks or, more likely, months, involving marketing, showings, negotiations, inspections, appraisals, and the whole closing process. If one of these strategies goes wrong, or if your personal financial situation changes unexpectedly, getting your capital back out of the property can be a slow and potentially costly process.
So even if you manage to successfully bypass that initial cash barrier to get into a property, you still absolutely need a solid plan to mitigate all these other ongoing risks: market, property, and financial.
Absolutely. The source material consistently stressed that mitigating these risks requires thorough due diligence before you ever commit to buying a property. That means detailed market research on the area, careful property inspection, often by professionals, accurate and conservative financial projections for income and expenses. And then, after you acquire the property, mitigation requires effective property management, whether you do it yourself or hire it out, rigorous tenant screening processes, and diligently building up cash reserves over time to cover those inevitable vacancies, unexpected repairs, or other unforeseen costs. Diversification, either by eventually owning multiple properties in different areas or using methods like REITs or crowdfunding to spread your risk, was also consistently highlighted as a key risk mitigation strategy in the long run.
So knowledge preparation, ongoing management, and building a safety net seem just as important, maybe even more important, than just finding the initial deal or the creative financing method.
They absolutely are. They represent your primary defense against the inherent risks of this asset class, particularly when you're starting out with a limited financial buffer of your own.
Wow. Okay, so we've covered quite a journey today, haven't we? Exploring a really diverse landscape of strategies, all aimed at helping people enter the real estate market without needing that traditionally required, often intimidating, mountain of cash up front.
Yeah, we really have. From leveraging your own need for housing with methods like house hacking or the live-in-then-rent approach, or even the demanding live-in flips, turning your personal situation directly into an investment advantage.
To ways of utilizing the capital of other people, either passively through accessible platforms like real estate crowdfunding and REITs, or much more actively by forming joint ventures with partners who have complementary resources.
We also explored some of the more, let's say, creative financing routes, like borrowing your down payment, and we have to reiterate the significant warnings that came with that one. Using private or hard money loans, while recognizing their high cost and inherent risk, considering master lease options for gaining control of larger properties, and navigating the complexities and severe seller risks associated with subject to deals, especially highlighted by those real-world Reddit discussions.
And finally, we looked at strategies that rely heavily on your personal effort, your market knowledge, and clever deal structure, like wholesaling properties or acting as a bird dog finding deals for others, or employing a rehab-focused scaling strategy like BRRR, while understanding it absolutely requires that initial capital to truly get the ball rolling and scale effectively.
I think the central and really quite powerful lesson that comes from diving into all these varied sources is this. While having a large pile of cash sitting in the bank is definitely the most traditional and perhaps the simplest path into owning real estate, it is emphatically not the only path available to people today.
So, investing in real estate with little or even effectively no money down is genuinely possible. But, and this feels like the crucial takeaway, the big asterisk, it is absolutely not some kind of magic button. It doesn't make the need for hard work, the presence of significant risk, or the requirement for deep knowledge just disappear.
Not at all. It absolutely requires creativity in finding opportunities and structuring deals. It demands detailed knowledge of your specific local market and the intricate mechanics of whichever strategy you choose to pursue. It often requires relentless hustle and persistence in execution. It necessitates a very clear-eyed understanding of all the risks involved and the discipline to actively manage those risks, everything from dealing with difficult tenants and surprise roof leaks to understanding the potential long-term financial fallout from strategies like subject to, particularly for the other party involved.
It really sounds like when you start with limited financial capital, your most valuable assets aren't necessarily in your bank account. They're things like your willingness to learn constantly, your capacity for sustained hard work, your ability to analyze opportunities critically and accurately, and your skill in building relationships, negotiating effectively, and structuring deals creatively.
Your intellectual capital and your personal grit arguably become your primary currency in this approach to investing.
So maybe a final thought for everyone listening. Considering the many different entry points and the various kinds of resources, not just cash that we've discussed today, what overlooked resource do you already possess? Perhaps it's your current living situation, maybe some unused renovation skills you have. Could it be your knack for finding off-market deals or your existing network of connections? What specific, perhaps underutilized resource could be your unique starting point to begin navigating the world of real estate investing?
That's a great question to ponder as you consider your own potential path forward in this space.
Well, thank you so much for joining us for this deep dive into the possibilities and the pitfalls of investing in real estate with little or no money.
It's always a pleasure exploring these strategies and sharing what we've learned.